$300 billion just flooded into silver in 48 hours. That's not speculation, that's market cap expansion. Shanghai Futures Exchange just announced zero lot delivery allocation for non-hedgers starting February 28th. Zero. Read that again. When an exchange admits it can't deliver physical metal, that's not a policy tweak. That's a confession of structural shortage. Current price, as I'm recording this on February 11th, silver spot sitting at $85.65. 2 days ago, it was trading near $80 per ounce. That's a 7% move in 48 hours on an asset with a $4.65 trillion market cap. Do the math yourself. 7% of $4.65 trillion equals roughly $300 billion added to silver's total valuation in 2 days. Verify the numbers. They're public. But here's what nobody's connecting. While Western markets were celebrating this rally, Shanghai implemented delivery restrictions. SHFE policy change goes live in 17 days. February 28th, participants without hedging quotas get zero physical allocation on all contracts. Think about what that means. The world's second largest silver exchange is rationing delivery before March contracts even expire. This isn't about managing volatility. This is about managing a shortage that can no longer be hidden behind paper contract settlement. Shanghai spot silver is currently trading at $80.67. That's a 4.02 premium over Western spot price for the exact same metal sitting in vaults. $4 premium means Eastern buyers are paying more for physical delivery than what paper contracts show in New York and London. That premium has been climbing steadily since January. Check the Shanghai Gold Exchange data yourself. It's updated daily and publicly accessible. While that premium was expanding, SHFE suspended 20 account groups in 7 days for trading violations. 20 suspensions in 1 week. When have you ever seen a major futures exchange suspend 20 participants in 7 days? Check Article 16 of SHFE regulations. It's documented. COMEX registered silver currently sits at 101 million ounces. Open interest on silver futures, roughly 68,000 contracts at 5,000 ounces each. That's 340 million ounces of paper claims against 101 million ounces of physical metal, actually sitting in vaults ready for delivery. Paper to physical ratio, 3.4 to 1. For every ounce of actual silver available, there are more than 3 claims on that same ounce. COMEX publishes these numbers daily. They're not hidden, they're not secret. Most people just don't look because they trust the system works. Yesterday alone, 861,000 ounces left COMEX vaults. 1 day. March contracts rolling forward at an accelerating pace as delivery date approaches. If this pace continues, there might be enough silver for March delivery. But that's a very big if that assumes no delivery pressure increases. Bloomberg just published coverage of Hong Kong retail demand surging ahead of Lunar New Year. Standard holiday buying story, right? Except Bloomberg specifically mentioned supply constraints and silver raising concerns about whether momentum can last. Read that line again. Supply constraints from Bloomberg, not alternative media, not conspiracy blogs. Mainstream financial media admitting shortage on air. They buried it halfway through the article where most readers skip past, but the ones who actually read, they caught it immediately. David Jensen from Mermican Capital just released new analysis warning that vault depletion is happening globally, not just in Western exchanges. His assessment, rapid decline of vault stocks plus surging lease rates, indicates metal flowing eastward as all vaults deplete simultaneously. His conclusion on volatility? Observers worried about the pace of silver's price increase haven't seen anything yet. Check his full report. Silver lease rates hit 4.89% yesterday before pulling back to 2.69% today. That's the kind of volatility that signals structural stress. When borrowing costs for physical metal swing that violently, it means someone somewhere is desperate for actual metal, not paper contracts. Bank of America just added precious metals to their bubble risk indicator alongside U.S. material stocks and South Korean equities. They're publishing weekly updates highlighting what they consider frothy markets using their proprietary bubble methodology. Metals made the list. So institutional banks are officially warning that gold and silver are showing bubble-like behavior. Clear sell signal, right? Except Wells Fargo raised their 2026 gold target to $6,100, $6,300 in the exact same week. That's over 20% upside from current levels. Their reasoning? Geopolitical risks, market volatility, and strong central bank demand. They called the recent pullback a healthy correction. 2 major banks, same week, completely opposite conclusions about precious metals. That tells you institutional confusion about what's actually happening. Daniel Oliver from Mermican Capital made the public case for gold, reaching $12,595 on dollar collapse scenarios. Not a YouTube conspiracy theorist. That's a capital manager running institutional money, presenting the logical mathematical endpoint of current monetary and fiscal policy trajectories. Whether you believe his specific price target or not, the directional thesis is becoming harder to argue against when you look at debt and balance sheets, And silver, with exploding industrial demand from solar, EVs, AI data centers, plus monetary demand, is the leverage play on that exact thesis. When gold moves, silver typically moves more violently in percentage terms. That pattern held true in this cycle, with 35% recovery in 5 days from lows. Here's what matters right now on February 11th. COMEX at 3.4 to 1 paper to physical. SHFE implementing zero lot restrictions in 17 days. Bloomberg admitting supply constraints. Wells Fargo raising targets. BOFA warning bubbles. Shanghai premium at $4.02 and climbing steadily. This is the setup. Physical separating from paper. Eastern markets paying premium for delivery. Western exchanges rationing allocation. If you're getting value from this breakdown, drop a comment. Let me know you're actually watching and connecting these data points yourself. The ones who verify what I'm showing here, who pull the actual exchange data, they already see what's building in real time. The question is whether you're the type who checks primary sources or the type who dismisses without looking and learns later at higher. China just weaponized silver. That's not hyperbole. That's official policy that went live January 1st, 41 days ago. Only 44 companies in China are now authorized to export silver for the next 2 years. 44 companies controlling access to metal. That's down from hundreds of smaller refiners who could freely export until December 31st. Beijing replaced open quotas with licensing requirements. To qualify for export authorization, companies need massive production capacity and state-approved credit lines. Small refiners were eliminated overnight. China controls 60 to 70% of global refined silver supply, not production. Refined supply ready for industrial use in manufacturing. The United States Geological Survey confirmed China processed over 21,000 tons of refined silver last year. Roughly 4,000 tons were exported. Analysts estimate Chinese exports will drop 30 to 50% in 2026 under the new licensing framework. That's 200 to 2,000 tons vanishing. Western manufacturers now need to find up to 2,000 tons of refined silver from sources that don't exist at current capacity levels. China didn't announce this as a trade restriction. They called it industrial security and resource security. Environmental protection was mentioned too. But here's what actually happened. China reclassified silver from ordinary commodity to strategic metal on January 1st. Identical regulatory status as rare earths. This follows the exact playbook Beijing used with gallium, germanium, tungsten, and antimony. Dominate refining, restrict exports, dictate terms. The United States added silver to its critical minerals list in November. Defense Department cited electrical circuits, batteries, solar cells, medical instruments. Elon Musk publicly criticized China's move on X, saying silver is needed in many industrial processes. He understands what's coming for Tesla's supply chain. Shanghai premium hasn't compressed under pressure. It expanded. Eastern buyers paying $4.02 more per ounce than Western spot despite export restrictions. That premium structure tells you physical demand in Asia is absorbing domestic supply faster than Beijing expected when designing the licensing system. Silver lease rates in London hit 8 to 9% this week, according to multiple sources. That's the cost of borrowing physical metal for delivery. When lease rates spike that high, it signals somebody desperately needs actual metal and can't access it through normal procurement channels at spot price. Bruce Ikemizu from Japan Bullion Association noted that platinum and palladium lease rates are also elevated. 3 structural deficit metals showing stress simultaneously. Let me connect this to broader geopolitical restructuring. China's share of U.S. imports just hit a 26-year low, according to recent trade data. They've been systematically decoupling from U.S. dependence for 5 years straight, while building alternative export markets in Asia, Middle East, Africa. The idea that tariffs damage China economically assumes China still depends on U.S. markets. That assumption is increasingly disconnected from current reality. While decoupling accelerated, China simultaneously implemented export controls on antimony in August, tungsten licensing in September, silver in January. These aren't random commodities. These are defense-critical materials essential for semiconductors, missiles, aerospace, solar panels, electric vehicles. China's strategy is transparent once you see the pattern. Build refining dominance, secure domestic supply, restrict exports, force price discovery upward. Beijing is trading short-term export revenue for long-term strategic leverage over Western industrial capacity and green energy transition supply chains. The Solar Energy Industries Association estimates that 50% of global solar panel production depends on Chinese refined silver availability. Europe's solar manufacturers are under immediate pressure. Reports indicate major tech corporations are attempting to buy directly at Shanghai Gold Exchange. They're trying to import metal through circuitous routing at exorbitant costs because Western refining capacity cannot replace Chinese supply at current scale. One major U.S. refiner is turning away ultra-pure silver. Not because the metal is bad, because refining capacity is completely maxed out domestically. Think about that. Western refiners at full capacity can't process additional supply, while demand is exploding for EVs, solar, AI data centers, 5G infrastructure. This is a supply chain choke point that takes years to resolve through capacity expansion, not months of throwing capital at the problem. Momentum Structures' Michael Oliver raised his 2026 silver price forecast to triple digits. He's citing structural supply deficit entering new elevated price range. His methodology references historical base metal breakouts from multi-decade price channels. Silver is showing identical technical setup to those precedents. Analysts from Asset Strategies. International noted last year was the 5th consecutive year of deficit silver production globally. 230 million ounce cumulative deficit. That deficit existed before China implemented licensing restrictions. Now subtract another 100 to 2,000 tons of Chinese refined exports from global supply. The bifurcation between paper and physical markets is expanding exactly as predicted. Dubai silver coins trading at $99.93, while COMEX March futures closed at $72. That's a $27 premium for physical delivery in Middle East markets. Paper contracts in New York are completely disconnected from physical reality. The current ratio of paper silver contracts to physical ounces backing those contracts, 356 to 1, according to Asset Strategies International's analysis. 356 paper promises for every single ounce of actual metal. That ratio doesn't hold when delivery pressure increases beyond normal settlement. Here's the scenario developing. Western manufacturers need refined silver for production. Chinese supply restricted. COMEX vaults depleting. Lease rates spiking. Shanghai premium persisting despite export controls. SHFE implementing zero lot allocations in 17 days. Bloomberg admitting supply constraints publicly. Every single data point confirms the same directional thesis. Physical metal is separating from paper pricing as delivery becomes increasingly difficult to execute. The ones dismissing this as temporary volatility aren't looking at refining capacity timelines or understanding how licensing systems create permanent market structure changes. China isn't reversing this policy, they're expanding it. Silver joins rare earths, tungsten, antimony on the strategic metals list with export authorization requirements. This is resource nationalism becoming permanent architecture of global commodity flows. Beijing picked the choke point metals and closed the valve systematically. The West has 3 options. Build domestic refining capacity over 5 to 7 years. Pay premium prices to approved Chinese exporters. Reduce industrial output. None of those options prevent price discovery from moving significantly higher as physical scarcity becomes undeniable across all major trading centers globally. Industrial demand just consumed over half of global silver supply for the first time in modern history. That's not a temporary spike. Solar panels alone ate through 230 million ounces in 2024. That number is projected to hit 300 million ounces annually by 2030. Think about what that means. One sector consuming more than 1/3 of total annual mine production just to keep solar installations expanding. Europe Union committed to delivering 700 gigawatts of solar capacity by 2030. China is building even faster with no published upper limit. Each photovoltaic panel requires 15 to 25 grams of silver. Advanced TOPCon solar technology requires 50% more silver than traditional panels. The solar industry isn't reducing silver intensity fast enough to offset the sheer scale of installation growth happening globally through this decade. Electric vehicles now use 25 to 50 grams of silver per unit. That's 2 to 3 times more than internal combustion engine vehicles require. Global EV production is forecast at 14 to 15 million units in 2026. Oxford Economics projects EVs will overtake combustion vehicles by 2027. By 2031, electric vehicles will account for 59% of total automotive silver demand. That's a structural shift happening over just 5 years. Charging infrastructure build-out adds additional silver consumption that isn't captured in per-vehicle estimates. Grid upgrades require massive conductor materials. Data centers consumed an estimated 350 million ounces of silver in 2025 between US and China alone. That exceeds 50% of global mining supply. IT power capacity increased 5,152% from 2000 to 2025. More computing hardware directly translates to proportionally greater silver demand in servers. AI acceleration is forcing data center expansion at rates nobody modeled 3 years ago. Every AI training cluster requires server density using silver connections. US government now classifies data centers as critical infrastructure. Tax breaks, fast-track approvals, grants flowing to expand capacity for cloud and AI services. 80% of global data centers are located in the United States. Their electricity demand is projected to grow 22% over the next decade. AI alone, on top of baseline data center electricity needs, is expected to grow 31% over the next 10 years according to industry forecasts. US data centers chose solar energy 5 times more than any other renewable in the past year. That creates compounding silver demand across linked sectors. The Silver Institute titled their December 2025 report, Silver, the Next Generation Metal. That's not marketing. That's recognition of structural transformation. Industrial silver demand now exceeds investment demand, jewelry demand, and all other uses combined. This has never happened in recorded commodity history. Silver's electrical conductivity is the highest of any element on Earth. You can't substitute it in high-performance applications without losing efficiency. Semiconductor manufacturers, 5G infrastructure, military electronics, medical devices all depend on silver's unique properties at scale that copper can't match. When Boeing builds aircraft electrical systems, when SpaceX launches satellites, when NVIDIA manufactures AI chips, they all need silver in precise quantities. None of these applications care about silver's price relative to gold. They care about availability and delivery timelines for production schedules. Industrial buyers don't speculate. They purchase forward contracts and secure physical allocation months in advance because production delays cost exponentially more. That creates a floor under demand that investment flows never provided. Industrial consumption is sticky, non-discretionary, and growing structurally faster than mining. Global silver production hit 819.7 million ounces in 2024. That's only 1% growth from 2023, despite prices surging throughout the year. Mining supply is structurally inelastic because over 70% of silver comes as byproduct of copper, zinc, lead, and gold mining operations. Miners don't increase copper production just because silver prices doubled. They mine copper based on copper economics, and silver output follows automatically. That means silver supply cannot respond to price signals the way standalone commodity mining typically responds when prices incentivize increased production. Primary silver mines exist but represent minority of global output. Opening new primary silver mines takes 7 to 10 years minimum from discovery to production. There are no shovel-ready, large-scale silver projects waiting for financing. The pipeline for new supply is essentially empty for the next 5 years minimum. Recycling provides secondary supply, but industrial applications destroy silver permanently through irretrievable dispersion in the electronics and solar panels at end of life. You can recycle jewelry. You can't economically recover silver from discarded smartphones and solar panels buried in landfills across developing nations. The Silver Institute documented 5 consecutive years of global supply deficit heading into 2025. Cumulative deficit, 230 million ounces over that period. That deficit existed before China implemented export licensing, before SHFE restricted delivery, before AI data center build-out accelerated beyond all projections. Asset strategies. International calculated current paper-to-physical ratio at 356 to 1. That's 356 derivative claims for every physical ounce backing those contracts. When industrial buyers compete with investment buyers for physical delivery, that ratio collapses violently because paper contracts settle in cash, not metal. Industrial manufacturers can't accept cash settlement. Tesla can't build cars with futures contracts. Solar companies can't install panels using COMEX receipts. They need physical metal delivered to refineries and manufacturing facilities on schedule, or entire production lines shut down at catastrophic cost. Frank Holmes, from U.S. Global Investors, stated silver's ability to be transformative in renewable energy is the outsized factor driving the latest price run. This isn't speculation from fringe analysts. This is mainstream institutional money managers publicly acknowledging the structural transformation of silver markets. Alex Tsepayev from B2 Prime Group noted that growing focus on renewables, especially solar panels, has boosted silver demand worldwide in ways that won't reverse. The energy transition isn't optional policy anymore. It's legally mandated infrastructure build-out across Europe, subsidized aggressively in US, and state-directed in China. Silver sits at the center of that transition with no viable substitute for its conductivity and reflectivity properties at the scale required. When governments commit to net zero targets, when corporations commit to ESG mandates, those commitments translate directly into physical silver consumption measured in millions of ounces. Gold-silver ratio compressed from over 100 to 1 down to 55 to 65 to 1 currently. If industrial demand persists, that ratio could hit 50 to 1 by year-end. That means silver outperforming gold on percentage terms despite gold sitting at record highs. The leverage to industrial demand is showing up in relative pricing. India became the world's largest silver importer in 2025 at $9.2 billion, despite prices nearly tripling in rupee terms domestically during the year. Indian imports jumped 44% over 2024, even as domestic silver crossed 2.43 lakh rupees per kilogram. That's demand that doesn't care about price levels. Substitution from gold to silver in jewelry, festive buying, plus India's expanding solar and electronics manufacturing, created resilient physical demand at any price. This is the setup on February 11th. Industrial demand structurally exceeds mining supply. China restricting refined exports. Western refining capacity maxed out completely. Solar, EVs, data centers, 5G, semiconductors, military, aerospace, all competing for the same constrained physical supply with no new mines coming online soon. Every data point confirms physical scarcity becoming undeniable. The question is whether paper markets can continue suppressing price discovery much longer. Here's what happens next. February 28th, 17 days from now, SHFE zero-lot delivery restrictions go live for non-hedgers. March COMEX contracts expire in 3 weeks. Current open interest sits at 68,000 contracts against 101 million ounces of registered inventory. If even 10% of those contracts demand physical delivery instead of cash settlement, the system breaks. That's 34 million ounces demanded. COMEX only has 101 million total registered. If multiple contract months simultaneously demand delivery, the math stops working very quickly. Watch what happens between now and March 31st. Watch whether Shanghai Premium expands or compresses under delivery pressure from both exchanges. Watch whether silver lease rates spike again above 5%, as borrowing costs signal physical tightness in London and Zurich vaults. Watch whether Bloomberg, Reuters, Financial Times start covering silver shortages more prominently, or whether they continue bearing it in midstream coverage. The bearish case is simple. Paper markets can suppress price for months or years through concentrated short positions and derivative leverage. Manipulation persisted for decades before JP Morgan paid $920 million settlement. Price suppression can outlast most traders' ability to stay solvent, but every suppression mechanism assumes paper markets maintain control over price discovery. That assumption is breaking down in real time. You cannot print physical metal. You cannot create refined silver through derivatives. You cannot deliver paper contracts to Tesla's production lines. When industrial buyers compete with investment buyers for constrained physical supply, cash settlement stops working because manufacturers need actual metal. China weaponized refining capacity. SHFE restricted delivery. COMEX vaults depleting, Western refiners at max capacity, solar and EV demand exploding structurally, data centers consuming more silver than total mine production, mining supply inelastic and unable to respond to price signals for 5 to 7 years minimum. Every single data point confirms the same directional thesis. Physical is separating from paper as delivery becomes increasingly difficult to execute. The $300 billion added to silver in 48 hours isn't the end of this move. It's the beginning of price discovery breaking free from paper suppression. Shanghai Premium at $4.02. Dubai Physical at $9 versus COMEX paper at $72. Lease rates spiking to 8%. 20 exchange suspensions in 7 days. These are not normal market conditions. These are structural stress signals indicating the paper pricing system is losing control over physical reality. This is financial education, not financial advice. Verify every data point yourself. Check SHFE announcements, pull COMEX vault reports daily, track Shanghai Gold Exchange premiums, read Bloomberg's actual articles word for word, not just headlines that bury the shortage admission halfway through. The ones who verify primary sources already see what's building. The ones who dismiss without checking will learn later when the data becomes undeniable. This is system-level change happening in real time. The question isn't whether it's happening. The question is whether you're paying attention.